A welcome rally in the first quarter with all the major U.S. indices advancing, but are the fundamentals really there to justify these gains? Let's bring in our great guests. Lee Munson is the Chief Investment Officer of Portfolio LLC. Josh Brown from Fusion Analytics, and here on set with us as well, Paul LaMonica, our very own CNN Money Assistant Managing Editor. Guys, thanks for being here. We're glad we have you guys because you make it very interesting. I want to throw the first question, though, to Lee. What do you think, Lee? We've got $100 oil. We've got Europe not exactly on stable ground. Why do the markets seem totally unfazed by this?
Well, they're unfazed because there's a few things that we know. First of all, Europe is just dead news. Nobody cares about Portugal going broke. There's still some questions about Spain. So I think that we have some fatigue, number one. Number two, $100 oil. It's great. You know, I think everybody's expecting if Iran blows up or it doesn't, you know, we're going to go down about 20 bucks a barrel. But I think at the end of the day, people are looking at the marginal improvements in economic indicators, and they're all going up.
You know, it's interesting, though, because this also has a lot to do with how well corporate America is performing. Josh, I was at Jim Beam headquarters in Chicago last week. They said we're seeing softness in Western Europe. Spain's a big concern. You look at Caterpillar, the reaction to China weakening from Cat last week. Should we care a little bit more about Europe and China right now?
You know, one of my themes since the beginning of the year was that the European thing would kind of subside. We knew that eventually they would become the Fed and backstop everything in sight, and that's exactly what they did. So in the absence of that, the new concern is how slow is China actually slowing?
Right.
Are we talking
What's
about
relative?
Well, are we talking about 7.5% GDP, or are we talking about worse? And right now, I think we don't know. And if you look at charts of super sensitive, you know, cyclical stocks, they look terrible. The money flow is clearly leaving. And I don't think, actually, that the corporate picture is that strong. I think we're seeing peak profit margins overall. But if you subtract Apple from the mix, for example,
right,
the earnings picture is significantly worse. And I think the last thing I'd bring out is last earnings quarter was mixed at best. We're going to start getting Q1 numbers in 2 weeks. And frankly, this is the first quarter where corporate profits are being announced against the backdrop of $100 oil over the course of almost the entire first quarter. So I don't know that we can say that we're in such a strong environment. We're certainly not betting that way.
So you sound a little bit like Ben Bernanke, a little less reserved. But Paul,
I don't know if that's a compliment or not.
I'll let you guess. Bernanke this week, you know, is basically saying, look, the good news recently overall with jobs is out of sync with the overall economy. And a lot of folks read that as QE3 is on the way. I don't know if you read it that way or not, but what's your take on that and how that affects these markets?
I don't think it's necessarily that QE3 is on the way as much as it is that Bernanke is reminding the market that anytime stocks stumble, if there's a hiccup and people start to panic, then maybe there could be some more easing. I mean, I think that's really what the market is kind of holding out hopes for right now, this kind of perfect world of the economy really is improving, but at the same time, Bernanke's not going to pull a Greenspan and jack up rates really aggressively and, you know, pull the punch bowl out, to use that famous metaphor.
Lee, want to bring you in here. First, quickly, your reaction on Bernanke. Are you on the same page as Paul? And then on top of that, are the markets being too complacent to what we're seeing out of China right now?
No, I think that, you know, first of all, think about what Paul just said. We have a put on the market. It's the Bernanke put. And so anytime there's, you know, growth, we don't have strong growth right now. Jobs are improving, GDP numbers are improving, but not that much. And so the markets are surging because, you know, what the Bernanke is saying is that I'm going to feed you guys to make sure that we stay on track. I think with China, we have to put China into its place. China is slowing because Europe is its largest export market, not the United States. And I think investors out there need to remember Europe buys more from China than the U.S. And so with Europe slowing, of course we're going to get China slowing. I think the real issue is how you position a portfolio and try to limit your Chinese exposure.
Lee, if you don't mind, let me just throw this out there. I think
sure, Josh.
Thank you, handsome. The dirty secret is that until you get 3.5%, 4% GDP, you don't escape from this. You never get quite to that level where jobs become self-sustaining, where hiring becomes self. If you don't get above that level, then it's always going to be artificial all the time. And I would argue the Bernanke put is a joke because really there's very little you can do against the backdrop of a balance sheet recession.
And has the market stopped?
Yeah, but
hold on one second here, Lee. I'll get your reaction on this. Has the market stopped pricing in the millions and millions of long-term unemployed in this country? Because even when the job report gets better, that doesn't change.
Well, that's the whole thing. So we had QE2. We had Operation Twist. These are beneficial to the stock market. These are not beneficial to hiring. You cannot show me job one that's been created. All you can say, and what the president is saying, is we're saving jobs.
And the market at some point has to react to Main Street, right?
You know, my clients buy price in a publicly traded market. We don't buy the economy. Josh has a good point. My point, I have to make money right now in the market. I'm not here to invest in an economy.